Hi everyone, what's up? Welcome back to my tutorial channel. It's Daniela Tran here, and today we are going to continue to work on IFM Practice problem. In the video today is section 5.2, the core level. Alright, let's look at problem 1. Company XYZ is attempting to fund capital investment. What is the preference order for the following option? From most preferable to least preferable, using the pecking order theory. 1. Convertible bonds. 2. Equity. 3. Internal financing. 4. Debt. So basically this question asks you to arrange these 4 types of options from the most preferable to the least preferable using the pecking order theory. So before we answer this question, let's recall the pecking order theory. The pecking order theory say that manager will prefer to use retained earnings and will only issue equity as the last resort. Which means no matter what option is, the last option is issuing equity. So here among these 4 choices, we basically can arrange it at any order, but we have to assure that equity is the last resort. So whatever order, as long as the equity 2 is the last resort. For example, we can arrange it 1 3 4 2 or 3 4 1 2 or 4 3 1 2, as long as number 2 is at the last option. Alright, problem 2. Company X and company Y has the same cost of capital and identical assets portfolios with a market value of 1,000. Company X has 0 debt. The expected return on equity of Company X is 15%. The firm value of Company Y is made up of 50% debt and 50% equity. The expected return on debt for Company Y is 9%. Assume that the Modigliani and Miller proposition hold. What is the expected return on equity in Company Y? So here we have 2 companies and it has the same cost of capital. And for Company X has no debt, we got equity expected return is 15%. Y has 50% debt, 50% equity, and the return on debt is 9%. And here we have an assumption of the propositions. Just to recall, the proposition in this case is the proposition 1 because there's no tax involved. And the proposition hold means we can apply the average, the weighted mean for the cost of capital. Now let's look at Company X. Company X has no debt, so the cost of capital of X should be the same with the expected return on equity, which is 15%. Now for Company Y, remember that X and Y have the same cost of capital, which means they have the same RU. So Company Y, we got RU is equal to 0.5 times RD plus 0.5 times RE by the proposition 1 without tax. And RD here is 9% given. RE is not given, but we know that the cost of capital of Y is the same with the cost of capital of X. So RU in Y should be 0.15 or 15%. So we have a new equation. 0.15 is equal to 0.5 times 0.09 plus 0.5 times RE. And this is just a simple linear equation. So go ahead and solve for RE. We got RE is 21%. And remember the proposition 1 with our text saying that RU, the cost of capital, this is I call it unlevered because we also have the levered case. So RU is equal to E over D plus E times RE plus D over E plus D times RD. E is the market value of equity. D is the market value of debt. RE is the expected return on equity. And RD is expected return on debt. So the answer to this question is 21%. Problem 3. Which of the following is referred as cashing out when a levered firm faces financial distress? A. The firm sells assets to pay cash dividend, even if this will reduce the firm's value. B. The firm sells assets to pay cash dividend, as this will increase the firm's value. C. The firm sells assets to pay debt to avoid bankruptcy, even if this will reduce the firm's value. D. The firm sells assets to pay debt to avoid bankruptcy, as this will increase the firm's value. E. None of the above is referred to as cashing out. So, to answer this question, basically we need to read the material to understand the situation when a company faces financial distress to understand what cashing out means. But to be simple, let's imagine if you're running a business and let's say your firm is facing financial distress. So what would you do? Right now, we don't talk about whether the firm value will increase or decrease after we make the decision, after we cash out. Let's just think about why we have to sell assets to get cash. Here we have two options. Either we sell assets to pay cash dividend, or we sell assets to pay debt to avoid bankruptcy. So let's say if you are the manager and your firm is facing bankruptcy, of course you're not gonna try to save the company in general. Usually you will sell the asset to pay cash dividend, and basically you pay the dividend to yourself and then leave the other on the cost of the debt holders, and the shareholders doesn't get anything. So basically that is how the manager would do, because the manager would do everything to get the most benefit for themselves, and the shareholder usually lose everything. So basically when a firm faces bankruptcy, debt holders will likely receive whatever the firm is worth, and the shareholders get nothing. But before the firm is bankrupted, the shareholders can sell assets for cash and pay dividend to themselves first. In this case, the shareholder benefit at the cost of the debt holders, even though this will reduce the firm's value. So A is the answer. And usually, the manager will, of course, sell the company to get cash and then share to all the dividend, the shareholders, and also themselves. And then, whatever left over will be on the debt holders. Problem 4. Which of the following is not an indirect cost of financial distress? A. Loss of customers. B. Loss of the employees. C. Loss of receivables. D. Fire sales of assets. E. Legal fees in bankruptcy. So here, when a company is facing financial distress, the indirect costs that come first should be the legal fees in bankruptcy. And loss in customer, or loss in employees, or loss in receivable, fire sales of asset will come later. So it should be the indirect cost. But the first cost they have to pay is the legal fee to in bankruptcy. So E is the answer. Problem 5 is a calculation problem. A firm is financed with both equity and debt. The firm's assets are expected to generate an income of $3,000 this year. You are given the market value of debt interest, the corporate tax rate. Determine the interest tax shield for this year. The interest tax shield is the interest payment times the corporate tax rate. And interest payment here is the market value of debt times with the debt interest. So we basically have to multiply these three numbers on the second column together. So the interest tax shield should be 367.5. Alright, so that's it for today. Thanks so much for watching. I hope you guys enjoyed my video. If you like this video, please like, share, and subscribe.